If you want to know where the American economy is truly weak, do not begin with the headlines that sound sophisticated. Do not begin with Federal Reserve speeches. Do not begin with GDP revisions. Do not begin with the stock market, because the stock market can flatter a country for a very long time, while the ground underneath ordinary people is already cracking. Begin with the borrower who cannot make the car payment. That is where I would begin. Because the man who misses his car payment is not usually speculating on abstract theories about the business cycle. He is not managing a narrative. He is not trying to sound intelligent. He is living the arithmetic of pressure in the most ordinary American way possible. He needs the car to get to work. He needs the car to hold the family together. He needs the car because in much of this country, not having a car means not having a life. And if even that payment begins to break, the problem is not usually the car. The problem is that the whole household has become too fragile for the claims piled on top of it. That is why I take this story seriously. Not because one bank issued one warning, because the car market is one of the clearest stress gauges in the entire economy. It sits close to the wage earner. It sits close to debt. It sits close to credit quality. It sits close to inflation. It sits close to consumer confidence. It sits close to the illusion that the middle class is still sturdy enough to keep financing its way through a more expensive life. When the car market starts breaking, it is not just an industry issue, it is a social balance sheet issue, and that is what I think many people still do not understand. They see auto delinquencies and repossessions and imagine this is a narrow corner of finance, some ugly little pocket of bad lending, some problem for dealerships, subprime borrowers, and banks with loose standards. No, what is happening in auto lending is much bigger than that. It is one of the purest examples of what happens when a society refuses to admit that prices have outrun reality, wages have not kept up, and credit has been asked to bridge the gap for far too long. That is the first mechanism. I call it debt as disguise. When a family cannot truly afford the asset at the current price, the modern system does not immediately tell the truth. It does not say, "You are priced out." It says, "Let us change the term. Let us stretch the years. Let us lower the monthly payment. Let us roll in the negative equity. Let us lend above the value. Let us pretend the problem is the structure of the loan rather than the impossibility of the price." That is what debt does in a late cycle economy. It disguises unaffordability as access, and the disguise can hold for a while. That is the dangerous part. People think because a loan was approved, the thing must have been affordable enough. That is backward. Approval often means only that the system found one more way to keep the illusion alive. That is what longer loan terms really are in this environment. They are not proof of flexibility. They are proof of strain. An 84-month auto loan is not financial innovation in the noble sense. It is an admission that the normal structure no longer works at the current price. That should bother you. Because once a society begins needing 7-year car debt to preserve the appearance of ordinary consumer life, you are no longer looking at healthy prosperity. You are looking at affordability failure being converted into time. And time is a cruel thing to borrow against a depreciating asset. That is the second mechanism. I call it paying future pain to preserve present normality. A car does not get better with age the way a good business can. A car does not quietly compound. A car gets older, a car gets used, a car gets worn, a car loses value, a car breaks. A car demands maintenance at exactly the moment the borrower is still trying to pay off the fantasy price that the last cycle encouraged him to accept. That is the trap. The payment may look manageable on the front end because the term was stretched like warm plastic. But the asset itself is still obeying the normal laws of depreciation. And in the early years especially, that depreciation is brutal. So now you have the most dangerous combination in consumer finance. A borrower making slow progress against principal while the collateral itself is falling in value faster than the loan is shrinking. That is how negative equity stops being a temporary nuisance and becomes a permanent climate. People like to speak about being underwater as though it were one bad event in this market. For many borrowers, being underwater is the default condition of ownership that matters because it changes behavior. A borrower with equity has options. A borrower deep underwater has psychology. He feels trapped. He feels stupid. He feels unable to exit cleanly. He feels as though the asset owns him more than he owns it. And if some income shock arrives on top of that, a cut in hours, a rent increase, a medical bill, a child care problem, a food bill that does not go back down. Then the loan starts competing with necessities rather than with luxuries. That is when delinquency begins. This is why the pandemic-era auto loans are so dangerous. Now, during the frenzy, people were not merely paying high prices. They were paying absurd prices in an environment where supply shortages, panic buying, market adjustments, and easy credit all joined hands and called the result normal. A vehicle that had a certain real economic value acquired a fantasy crisis value. Consumers paid it, dealers charged it, banks financed it, and because the whole machine was moving at once, people told themselves it must therefore be rational. That is how bubbles always defend themselves in real time. Everybody is doing it. Everybody is approving it. Everybody is adapting to it. Therefore, it must be fine. No, a collectively tolerated absurdity is still absurd. The only question is how long the denial can survive before the balance sheet forces honesty back into the room. And that, I think, is exactly where we are now. We are living in the lag, that is the third mechanism. I call it delayed recognition. The most expensive consumer bubbles rarely collapse at the moment of purchase. They collapse later when the emotional heat is gone, but the financing structure remains. The man who paid $70,000 for a car that now trades in the 30s does not feel the full stupidity of the purchase the first week. He feels it later. He feels it when the novelty is gone. He feels it when the payment is still there. He feels it when the car is worth far less than what he owes. He feels it when he cannot trade out of it. He feels it when life gets tighter and the note remains as large and indifferent as ever. That is when the bubble turns from a market event into a household event. This is why I care so much about the timing window mentioned in the source material. The danger zone in auto defaults is not random. It is where the borrower has already lived with the strain long enough. The novelty has vanished. The equity hole is obvious. The principal has not fallen enough, and the rest of the economy has had time to start working against him. That is when a bad decision becomes an unavoidable fact. And a lot of those pandemic loans are reaching exactly that stretch now, which means the current delinquency data may not represent the end of the problem. It may represent the middle. Now let us talk about the banks, because this is where the story becomes even more revealing. The public still likes to imagine banks as neutral judges of affordability. That is a charming illusion. A bank is not in the business of telling the truth early, if a profitable extension of the lie is still available. That is not cynicism. That is function. Banks make money by writing loans and collecting interest. If cars become unaffordable at traditional structures, the bank's first instinct is not necessarily to force prices down by refusing the game. The bank's first instinct is often to alter the game enough that the loan can still be written. Longer terms, higher loan to value, more tolerance, more extension, more working with the customer. And of course, all of this is described in humane language, helping the borrower, meeting the customer where they are, offering flexibility, supporting mobility, fine. But beneath the kindness language lies a much simpler truth. The credit system is trying to preserve the transaction that matters. Because when the credit system preserves the transaction, instead of disciplining the price, prices remain too high for longer than they should. That is the fourth mechanism. I call it finance protecting the sticker. In a healthy market, if buyers cannot afford the price eventually has to come down. That is what truth looks like. In a debt-saturated market, the price can stay foolish because financing bends around it. The dealer still gets paid, the borrower still gets the keys, the bank still books the loan, and reality is not removed, postponed. That is an important distinction. Markets rarely abolish truth, they defer it. This is why loan-to-value ratios matter so much. If banks are financing well above the value of the car, then the problem is not merely that borrowers are stretched. The problem is that the financial system itself is helping preserve a pricing structure that should already have been forced lower by common sense. And once that happens, everybody in the chain begins depending on continued denial. The dealer depends on it. The lender depends on it. The borrower depends on it. And because they all depend on it at once, the system develops a bizarre social agreement to keep pretending the numbers are normal. That is what extend and pretend really means. It is not merely a bank phrase. It is the whole culture of late-cycle consumer finance in miniature. We know the borrower is in trouble. We know the collateral is weak. We know the note is too large. We know the equity is negative. We know the structure is bad. But if admitting all of that today forces recognition of losses, tighter standards, uglier numbers, and more visible crisis, then everyone reaches for one more month of denial. That is what I mean by extend and pretend. It is the modern language of refusing to crystallize the truth, while the paper story can still be protected. This is the fifth mechanism. I call it manufactured calm. Nothing is calmer on paper than a problem whose recognition has been delayed. That is why I never trust low-stress optics in a high-stress system. If repossessions should be happening faster but are not, that does not necessarily mean the borrower is healthier. If bad loans are still sitting there without visible fireworks, that does not necessarily mean the cycle has stabilized. Sometimes it simply means the administrative, legal, logistical, and reputational machinery of recognition has slowed down. That matters enormously, especially when the slowdown itself lets policymakers, analysts, and executives speak as though the numbers are still manageable. Because once recognition catches up, what looked like a contained issue can suddenly become a headline crisis. Now let us go one level lower, because I think the source material touches something even more corrosive than high prices and long terms. Fraud. This is where stress reveals the true condition of the system. When a market is healthy enough, fraud still exists, of course, but it lives more at the edges. When desperation meets enabling technology inside an already distorted credit system, fraud begins moving toward the center. That is what credit washing tells you. It tells you borrowers are not merely stretched. Some are so far outside clean affordability that they feel compelled to manipulate the gate itself. It tells you the system is not merely expensive. It is psychologically broken enough that fake creditworthiness begins looking like one of the few remaining admission tickets. And the arrival of AI into that space is not some cute side detail. It is an accelerant. This is the sixth mechanism. I call it desperation plus automation. A weak borrower in an honest analog system might fail quietly. A weak borrower in a digitized, overstretched AI-assisted system can industrialize deception, spam the bureaus, dispute everything, temporarily inflate the score, get the approval, drive off, leave the lender holding the fantasy. That is not just a crime story, it is a stress story. Because fraud rises when the line between I want the car and I need the car to keep functioning collapses under economic pressure. The system then becomes even more dangerous because the numbers no longer describe only honest weakness. They begin describing weakness mixed with contamination, and contaminated credit systems do not usually get healthier gently. They either tighten hard or they absorb losses painfully. That is the choice. Now let us widen the lens. Why does any of this matter beyond cars? Because the car loan is one of the most direct and democratic forms of household credit stress in the country. Not everyone owns stocks. Not everyone owns a home. Not everyone borrows for a business. But millions of people borrow for cars because the geography of American life forces them to. So when auto delinquencies rise, especially in ugly structures, you are not merely looking at niche financial misconduct. You are looking at one of the closest things the economy has to a live stress test on the lower and middle parts of the consumer ladder. That is why I take it seriously. The car note sits near wages. The car note sits near rents. The car note sits near groceries. The car note sits near everything inflation damaged. And if enough households begin failing there, then the broader story becomes harder to avoid. Maybe the labor market is not as healthy as the top-line numbers suggest. Maybe the pandemic distortions never really healed. Maybe the middle class has been surviving on financing tricks more than anyone wanted to admit. Maybe the real affordability crisis is much wider than housing alone. Maybe the economy looks stronger from Wall Street than it feels from the parking lot. That is the seventh mechanism. I call it the parking lot recession signal. Economists and television personalities love abstractions. The man at the edge of repossession lives a simpler truth. He can pay or he cannot. If he cannot, and if a lot of others cannot, then the machine is weaker than the official mood suggests. That is why I have always liked looking where the pressure is most ordinary. The most revealing economic data often lives where life is least glamorous. Now let us talk about the used car dealer in the source, because I think his perspective reveals something most macro commentary misses. Stress does not hit every participant the same way. Some pain creates strange opportunities lower down the chain. More people who can no longer qualify for large loans may drift toward cheaper cash purchases that can help the lowest end dealer at the margin. Fine, but even there the situation is not clean because the same tightening that creates some new buyers also reduces supply, weakens trade inflow, worsens quality, and damages the inventory pipeline. That is a very American kind of late cycle problem. Demand and supply both get damaged by the same underlying stress, just in different directions, and the small operator has to survive inside both. That is why I think this story is not just about banks and borrowers. It is about the entire ecosystem that develops once a society normalizes overpriced, debt-supported access to things people cannot live without. Everybody gets distorted. Borrowers get stretched. Dealers get addicted to financing support. Banks get addicted to keeping the paper alive. Used sellers get whipsawed by credit conditions they do not control. And then commentators show up afterward and describe the wreckage as though it were unfortunate weather. No, it was structure. Now, if you ask me what comes next, I think the most likely path is ugly but familiar. Loss recognition will creep before it sprints. Banks and finance companies will increase reserves. Some will keep extending until the accounting or regulatory pressure becomes too visible. Used prices may soften in some categories, but not enough to make the average borrower feel rescued, because affordability is no longer only a price issue. It is a household cash flow issue. Repossessions will become more visible. Fraud controls will tighten. Marginal borrowers will lose access. Dealers will complain about weak traffic and bad financing conditions in the same breath. And eventually the public will start talking about an unexpected consumer credit shock as though no one could have seen it building. But the truth is not unexpected at all. The structure has been telling the story for years. Pandemic overpricing, longer terms, higher loan to value, more negative equity, worse credit quality, more delinquency, more extension, more fraud, more reserves. There is nothing mysterious here. The only mystery is how long people can call a widening crack a stable foundation. Now let me tell you what I think the real lesson is. The real lesson is not that cars are bad. The real lesson is not even that auto lending got reckless. The real lesson is that when a society keeps solving an affordability crisis with financing tricks, instead of price discipline and income growth, it eventually produces a consumer class that looks solvent only because truth has been stretched over time. That is not prosperity. That is deferred recognition. And deferred recognition always arrives eventually. That is why I say the auto loan crisis is a warning to the whole U.S. economy. It is not the only weak place, but it is one of the clearest because cars are ordinary, cars are necessary, cars are financed, cars are collateral, cars sit right on top of the worker's monthly life. When even that system starts showing this much strain, it tells you something severe. It tells you the consumer has less cushion than the market wants to believe. It tells you inflation did more structural damage than a few easing prints can erase. It tells you credit was used not merely to accelerate consumption, but to disguise unaffordability. It tells you banks are still trying to protect transaction volume even when truth would require tighter pain. Now, and it tells you that what looks like a niche lending issue is often just the first visible fracture in a much larger economic wall. That is the final point. The car market is not separate from the economy. It is one of the places where the economy loses the ability to lie elegantly. That is why I would watch it closely. Because when ordinary borrowers start breaking under ordinary assets, financed through extraordinary terms, you are no longer looking at a healthy expansion. You are looking at the consumer telling the truth before the rest of the system is ready to admit it. And the consumer, when pressured enough, always tells the truth eventually.